Good afternoon, everyone. My name is Max Clark, and on behalf of the Fox Alliance, we are grateful that you have chosen to join us this afternoon for our second quarter Beyond the Noise webcast, which we have titled Dissecting a Recession. We're going to be taking a look at a lot of the data points that we see in the economy to determine kind of what direction that's heading, to see if we actually believe we're headed into a recession. And then we'll wrap things up by giving our thoughts on the implications of that and what that looks like. We've got a couple of people that will be joining us today on the call. I will be the first presenter. My name is Max Clark. As I mentioned earlier, I'm one of the wealth advisors here at the Fox Alliance. The second presenter will be Laura Cooper, who many of you guys know. She is your wealth advisor here with the Fox Alliance as well. And then Josh Renfro, one of the partners at the Fox Alliance, will be wrapping up the conversation for us today. If you have any questions, we would ask that you please send those to my email address, max@the-Fox Alliance, and we'll get those answered. Due to regulatory restraints, we're unable to accept questions via Zoom, so that functionality has been disabled. But if you'd like to send us questions, please do so by sending them to max@thefoxalliance.com. Well, let's go ahead and get started by answering the question to begin with: what is a recession? According to Investopedia, a recession is a significant, widespread, and prolonged downturn in economic activity. Many of you guys probably know about the rule of thumb that helps us kind of determine when a recession is occurring and when it's not, and that is 2 back-to-back quarters of declining GDP. That makes a lot of sense because, when you look at this definition, a significant, widespread, and prolonged downturn in economic activity, 2 back-to-back quarters of declining economic growth in the economy makes sense. But oftentimes a recession isn't that simple. It is accompanied by many other things that occur. One of the key things that occurs during a recession is the unemployment rate rises. People begin losing their jobs. And this really is kind of a domino effect, because as people lose their jobs, they stop spending less. Or they stop spending as much. They start spending less. Consumer purchases accordingly fall off. And as revenues fall for businesses, many businesses end up going bankrupt. And as people have lost their jobs, they may be unable to continue to fund their mortgage, and therefore people lose their homes. And because of this economic downturn, oftentimes you'll see young people that can't get a job after school, because obviously there aren't many jobs available. So with all of this in mind, the real question is, where are we now? And are we heading into this recession, or are we not? Well, let's kick things off by taking a look at the labor market, answering the question, where do we stand now? Many of you guys have probably been hearing in the news about all of the layoffs that have been occurring across the economy. And most of those have been, or I should say, the large spike that we've seen has been occurring in the tech sector. So you can see this chart looks back to January of 2022, January of last year, and helps us understand where, in kind of within which companies, those tech layoffs have occurred. So you can see back in January, about 631 tech layoffs occurred. But by November of last year, almost 60,000 occurred. Some of those occurring at Meta, Amazon, Twitter. And you can see just kind of across the board where that all occurred. And if we stretch this chart out just a little bit further, that previous chart only went through November. Let's look through just last month. And you can see that in January, it actually hit almost 90,000. And just for last month, we're at a little over 37,000. So the tech side of things has certainly experienced meaningful layoffs. But I think a better question would be, where do layoffs stand across the entire labor market for the United States? And if we take a look at that, this looks at 1 year longer than that previous chart, going back to January of 2021. And you can see that layoffs across the board have kind of been up and down. We haven't seen a meaningful spike. It started out back here in January of 21 at about 1.6 million, fell down, rose back up. We're still about 1.5 million. But let's put this in the context of a much longer time period. Let's look back over the last 5 years. Well, from February of 2018 until now, you can see that prior to COVID, normal layoffs on a monthly basis were somewhere around 1.9, 2 million. We obviously saw a meaningful spike in the COVID time period, but so far over the last year or two, Right around 1.5 million is pretty normal. So when we look at the labor market, specifically with regard to layoffs, while we've seen a specific industry, the tech industry, experience a spike in layoffs, broadly speaking, there's not much that we see here that's terribly concerning from a layoff standpoint. Now, another part of the labor market that's important to look at would be the unemployment rate. So when layoffs spike, you would expect the unemployment rate to rise. Well, if we look back over the last 10 years, you can see that back in February of 2013, it was somewhere around 7.5%, 8%, the unemployment rate was, and it was steadily declining. And it declined almost to about 3.4, 3.5%. We then, of course, had a major spike in the COVID time period, and it's subsequently come back down. And we are just above the lowest that we've seen in effectively the last 50, 60 years at 3.6%. And one of the reasons that the unemployment rate probably hasn't spiked as much is in the midst of COVID over the last several years, you saw many people step up in their jobs. So maybe they were an hourly worker and they ended up moving up to, say, become a manager, a salaried employee at an Amazon distribution center. Well, those were some of the people that have been laid off in the tech industry over the last couple of years. And instead of going on to unemployment, what they did was simply move back to their hourly jobs that they saw before. So while their income has come down and they don't have the same quality of job that they had before, they're not claiming unemployment because they're able to go back to the type of job that they had before. That's not the case in every situation, but that's certainly been a widespread reality in that tech industry space, which is one of the reasons that we haven't seen unemployment rates rise as much as you might expect. Now, if we do end up going into recession, this is a key thing to keep an eye on because we would expect unemployment rates to rise going forward. Another key factor as it relates to the labor market is participation rate. So the participation rate really is a measure of what percentage of the working age population in the United States is actually participating in the workforce. Well, back 10 years ago, it was about 63.5. And if you look today, we're at 62.6. So we've seen almost a 1% decrease in the participation rate over the last 10 years. That's pretty meaningful because when you put that in the context of the entire working age population, that works out to about 6 to 8 million people that have left the workforce for one reason or another. And when you look at the number of open jobs, which is somewhere around 9 or 10 million right now, we're in a position where having 6 to 8 million people leave the workforce has really created a pretty tight labor market for us. So all of these situations suggest to us that we're not in a real recessionary type of environment from a labor standpoint. Now let's look at a couple of other factors. One of those is productivity. Productivity speaks to how productive we are as an economy per worker that is doing work. So what effectively you saw in the midst of COVID, when a lot of people get laid off, individual workers become more productive. They're able to accomplish more for a couple of reasons. One, they don't want to get laid off themselves, so they improve their work quality and efficiency. But two, because they have less workers, they have to figure out how to be more productive. So oftentimes when you're going into a recession or you're in the midst of a recession, you might see productivity tick up. Well, over the last couple of months or years, we've seen that actually come down. So on a year over year basis, we're actually productivity is down a little bit, about 1.8%, 2% over the last year over year basis. Now, when we put this in the context of the broader, say last 10 years, not on a year over year basis, but just kind of an index basis, starting at 100 back in 2012, we're up pretty meaningfully. We're up about 13.3% over the last 10 years. So productivity has improved. It's ticked down a little bit recently, but we're still meaningfully higher. I wouldn't say there's a lot of indicators here of a meaningful recession going forward. Now I'm going to go ahead and turn this over to Laura, who will take over from here and walk through the health of the consumer and a few other points before turning it over to Josh. Laura, why don't you go ahead and take it away?
Awesome. Thanks, Max. So as Max mentioned at the beginning, when we look at kind of what happens in a recession, two big areas to look at are how does the consumer behave? And then subsequently, how does that affect businesses? So We're going to look at a few different factors of consumer health in a recession, and then how that affects business health in a recession. So let's start with consumer spending. So we're looking here at retail sales month over month change going back to 2018. And as you can see, we've got a pretty large spike here month over month in COVID. And a lot of these charts we look at, you're going to see some pretty interesting activity happening around the 2020, 2021 timeframe. Now, one of the really interesting things is, the spike in the change, the month over month change in COVID is pretty predictable, but what becomes a little bit less predictable is this change in 2021 and 2022. And this is kind of the catalyst for the inflation that we're seeing today. We had a lot of stimulus injected into the economy in 2020, and a lot of that money started really getting spent in the economy in 2021. And so one of the biggest questions that we get is, why are we having such high inflation right now? What's going on? What caused this? Looking at this chart, we can really see consumer spending on a month over month basis just really exploded in 2021. And today we're at 3.2%, not necessarily close to the bottom. We're still spending as consumers at a pretty healthy rate. Looking at this number and from a total perspective, going back almost a decade, the slope of the line here from 2013 to pre-pandemic is a little bit shallower than the slope of the line here from post-pandemic to where we are today. And there's a couple big reasons for that. As I mentioned, we had a lot of stimulus in the economy. Consumers are spending a lot more than we were before the pandemic, but also inflation. Inflation is a real has real effects on how people spend, and this is personal consumption expenditure. So how much are people having to spend on a normal basis? So we're at 18.1 billion today, which is the highest that we've been in a decade. If we take a look at this from a year over year change, as I mentioned, this really helps to show that change in the slope of that line. So pre-pandemic, that personal consumption year over year number was hovering right around 5%, a little lower than 5%. Today we're at 7.6%. So the amount that we're spending as consumers has gone up, and the rate at which we're spending has gone up. Now let's take a look at debt, and then we're going to look at savings, personal savings. But on the debt side, here we have total non-house consumer debt. So debt outside of your mortgage. This could be car loans, credit card debt, student loans. And in 2020, we actually saw a decrease in total debt. A lot of people were using their stimulus checks, and they weren't spending as much, and so they were paying down their debt. But that has since changed, and that total debt number has gone up quite a bit over the last couple of years to today be at 4.6 trillion. And one other thing when it comes to that debt, a big question, we're going to look at savings here in a second. Oops. Sorry about that. We're going to look at savings here in a second, but going back to debt, this also shows you how inflation can affect people's bottom line. When you have inflation, and if your income is not going up as much as the cost of goods, a lot of people end up having to supplement their income with debt. We're also in an environment right now where, coming out of the pandemic, where we were locked in our houses for 6 months, some people much longer, the desire to spend and enjoy life and kind of get to do all these things that we didn't get to do for a while is still there. And that's affecting people longer term. And this kind of creates a feedback loop where we have inflation, the things become more expensive, people take out debt to therefore continue to buy, and inflation continues to go up. And this is consumer debt service as a percent of disposable personal income. So how much are people having to shell out each month in order to service their debt? And we're at 5.73%, which historically is actually not that bad. I mean, if we look back at 2000, 2001, that number was much higher. but it is a little bit on the uptrend. So this is a number that we will continue to take a look at and keep an eye on as we, again, fall into this feedback loop of rising prices and people continuing to spend. Now, on the flip side of that, we've got savings, and this number actually might seem kind of surprising. So we had a gigantic spike in savings and currency in the United States from 2020 until today. One of the biggest reasons for this is stimulus checks. I mean, we increased the monetary supply in the United States by 40% over a 60-day period in 2020 to try to rescue the economy from COVID. And today we're at 4.8 trillion, which is a slight decline from the peak in June of 2022. And this is not just household cash, people's savings account and checking accounts. This could be cash held in your investment accounts. There are a lot of folks who, when things get a little bit volatile in the markets, choose to go into cash and take money out of investments. There's been a lot of people who made a lot of money in real estate and land and businesses over the last couple of years who've chosen to sold and stay on the sidelines for a good opportunity. So we've seen a 500% almost increase in the amount of cash, checkable deposits, and currency in the United States. And I think this chart really goes to show when we ask the question of, is spending going to slow down? Are we heading into a recession? Is inflation going to slow down? This chart is really eye-opening to answer that question. So on the left-hand side here, we've got percent change or percent increase in checkable deposits and currency related to pre-pandemic averages. On the bottom here, we're looking at income, household income relative to quintiles. So, 0 to 20% household income versus 80 to 100. And on the right, we've got the share of total consumption expenditure. And so what we see here, the top 4 quintiles consist of 90% of all consumption and spending in the United States. And they also have, in some cases, 300 to 500% more cash in their pockets today than they did pre-pandemic. That is a big deal because, again, thinking about that feedback loop, thinking about why inflation has been a little bit stickier than maybe the Fed or even analysts have thought they would be, this is a very telltale sign that continues to feed that loop. And this has to change in order for us to really start to see a recessionary environment. The last thing I'll finish out here with consumers is real disposable personal income. So after all bills are paid, how much are people able to spend, or what's their income? And the trend line here, this dotted line, shows the pre-pandemic average. And then we have this huge spike in 2020 and 2021. Again, stimulus checks. But we start to see that decline past the trend to where we are today. And this right here is a really great indication of what inflation can do to a person's bottom line, to their personal budget. So we're at 15.6 trillion today, flattening out and seems to be actually on an uptrend over the last 6 months. But this is also something that we need to take a look at and consider. This piece will have an effect when it comes to inflation and a potential recession. So we're going to switch over to looking at the health of businesses, starting with profits. On the left-hand side, we've got S&P 500 earnings per share estimates, or actual earnings per share, and then estimates. So this green bar here in 2022 is signifying what we call an earnings recession. If you've had a review with one of your advisors in the last few months, we've talked a lot about what happened in 2022, and we did see a pretty dramatic decrease in earnings across the board. But the expectation from analysts is that over the next 3 to 4 quarters, we're going to see a very large increase in earnings and record earnings going all the way back to 1988. So companies are expected from an earnings perspective to be very healthy, and corporate profits after tax, even though it's come down a little bit in the last year or so, is still much higher than it was pre-pandemic. Same thing with profit margins. So we've had a pretty big spike in 2021 and 2022 that came down, but that is expected to continue on the uptrend. Now, looking at businesses, the one area of the economy that actually looks a little bit recessionary or a little bit concerning is the manufacturing index. And when we look at what we call leading indicators for recession, manufacturing is one of those leading indicators that can really kind of help to tell you, okay, we're heading into a decline in activity or not. So manufacturing real sector output for all workers has slightly declined from 2021 or from 2022 into 2023. Now, not nearly as bad as it did in 2020, but if we look at the ISM Manufacturing Index, which is a really telling index and one of the major indices used for looking at recessions and how the manufacturing sector is if it's healthy or not, it has been on the decline since 2021. And we've broken this 50 number, which is considered a sign of a true contraction in the manufacturing sector. So looking at manufacturing on its own, it looks like we might be leading towards some contraction in the economy. But if we look at the health of the consumer and the health of businesses as a whole, we're in a really healthy economy overall. And at this point, it's just a question of which sectors, if any, are going to experience decline and contraction. So with that, I'll turn it over to Josh to finish this out.
Thank you, Laura. Joy of lighting. Let's go ahead. I want to wrap up with a couple of the major points here before giving final thoughts and conclusions. So first off, where do we stand now when it comes to some final points in business? So first, gross private domestic investment has continued to increase. It did decline a little bit in 2021, but started to uptick in 2022, which was another positive component here. The final thing, and this I do want to spend a little bit more time on and working through, is gross domestic product. So last year, the traditional sign of a recession occurred. In the first and second quarter, we had GDP decline by 1.6% and then by 0.6% on a real basis, followed by 2 quarters of pretty strong growth, 3.2 and 2.9, with the year finishing positive. So the question is, why are people not declaring last year a normal traditional recession? And so the answer to that question, some people might say it's political, and I'm sure that there's a component to where that's true. But the one other thing that does, as we've mentioned before, is most of the conditions we've looked at this year don't point to a traditional recessionary kind of environment. But the other big thing is this: there's a huge difference between real GDP growth and nominal GDP growth. So in an environment where you have very high inflation, you can actually still have the economy growing. It just happens to grow at a lower rate than inflation, and it will show up as negative. So as an example, if you have inflation in a quarter of, let's say, 4%, as an example, and then you have GDP go up 3%, you will have a real GDP growth of negative 1%. So let me just go through that math again. Inflation of 4% for the quarter, GDP growth of 3%. The difference between that is 1%. So as a result, you would have real GDP growth of negative 1% in that situation. And of course, in the first and second quarter of 2022, we had very high inflation. And so that's the other reason a lot of people discount these 2 particular quarters as not being a sign that the recession is ultimately hit, because we did have we had nominal GDP growth. It's just that GDP growth did not exceed the inflation numbers. So with that, I wanted to kind of conclude with this comment. If we look at all the data we've presented today, if we look at the stuff that you hear on the news and everything else, the question is, would it seem natural to assume that a recession is impending? And the answer to that question is no. It's not. There's a few concerning pieces out there with the manufacturing and a couple of other smaller ones. So by and large, with the labor markets, the business markets, most of these things seem quite positive. So do we believe that a recession is likely? And the answer is absolutely yes. Why? Because it's exactly for those reasons. It's because the economy is doing as well as it is that we do think a recession is likely to happen. Why? When you bring inflation into the mix, it changes everything. What was once good news can now become bad news. The reason that inflation continues to be persistent and sticky is because the economy continues to do well. And as a result, prices continue to increase. And that continues to force the central bank and the Federal Reserve's hand in increasing interest rates over the long term and doing other monetary tightenings as well. I mean, we saw this literally the week after the Silicon Valley Bank failure. The central bank still raised interest rates 0.25%, despite a lot of fear in the markets that we could begin to see the massive drawdown of small and regional banks across the United States. They still increased interest rates despite that happening. And it shows just how strong their resolve is to stop inflation. So from our perspective, there are two statistics here that have to be remembered. First, there's not been a single instance in US or world history where inflation has gone, and let me rephrase that, specifically in US history, where inflation has gone above 5% and we have not seen a recession take place as a necessary catalyst for getting back to normal inflation, 2% or so. On the flip side of that, we have never seen a 4% drop in inflation where a recession wasn't the catalyst for that drop as well. So is it possible this time is different? Yes, but if you talk to any economist and any major investment professional, saying those words are a dangerous course, and that's something that we don't think makes a lot of sense in the environment that we're in right now. A couple of other leading recessionary indicators, which we do believe point to a recession. One, the inverted yield curve. The inverted yield curve simply reflects the idea that people are willing to pay, people are expecting a higher interest rate in the short term versus the long term. What does that communicate? It communicates that they expect the risk to the economy in the short term to be higher than it is in the long term. And therefore, and historically, this has been a very accurate indicator that a recession is likely to come. Another one would be a decrease in building permits for new homes, followed by a decrease in consumer sentiment, decline in manufacturing orders for new goods, and a decline in CPI, being the fifth one in this situation. The only other thing that would potentially you'd have to look at when you're trying to dissect whether recession is likely outside of the inflation component we've talked about is there a major asset bubble? Oftentimes in an environment where there is a major asset bubble, a lot of the traditional things will look pretty good, but you will usually find some fault lines built into some of these areas. So as an example, let's take a look at the dot-com bubble. I'm sorry, actually, let's look at the real estate bubble in 2008. In the real estate bubble in 2008, you would have seen a lot of these numbers would have looked really healthy, but one area would not have looked very healthy. And that would have been the consumer debt side of things, because consumers were taking out far more debt to try to buy more real estate than they could handle. And so those two things would have matched up in a substantial way. You go back to the dot-com bubble, and you saw lots of people investing in companies that weren't making any revenue or weren't making any profits. And as a result, the amount of cash that overall individuals had was one of the lowest levels that we've seen in 70 or 80 years. So the point simply is this: we do not believe, if you look at the historical bubbles that have really brought down the markets in past years, and really some of the ones in the most recent years, we don't see a lot of telltale signs of that happening in this particular situation. Now, having said that, there are some small and what I would call medium-sized bubbles that could be beginning to show themselves. First of which is in real estate. Specifically, I want to be very clear here, specifically in office real estate. Of the 5 major food groups, retail, apartments, industrial, self-storage, and office, we think that 4 of those are fairly healthy. But office specifically has the most challenges. The overall vacancy rate in the office market is already 16%. That number is likely to increase. In some markets like San Francisco, that vacancy rate is literally 30%. And so that is an area where you could really start to see some fire sales as people try to get out of assets that they believe are going to be anchors weighing them down long term. Blockchain related investments. We've already seen this bubble pop 70 or 80%, but it's come back 40 or 50%. But this is an asset class that is incredibly volatile. We could definitely see some additional bubble-like activity along the way. The last area, and this might surprise you, is investments in artificial intelligence. We are very early in this phase, and there's not been a lot of discussion by those who are developing artificial intelligence on what their monetization plan is. Very similarly to the dot-com bubble, yes, is the internet going to be a big deal? Yes. But of the thousands of companies that were started during the dot-com bubble, there are next to none of them that are actually here today, because so many of them could not generate a plan to get themselves to favorable monetization where they could actually become profitable. And so that's another big one that could potentially, not in the near future, but potentially in the next couple of years, start to spread its head. Let's talk about winners and losers. In a recessionary environment, the natural thought is there is no winners. Everybody's a loser. And that's actually not true. There are actually two major winners in a recession, the first of which is the best and the brightest. What does a recession do? It's truly survival of the fittest at its finest. You see companies that otherwise wouldn't have made it during a more competitive environment enter into a recession where the environment is very challenging. And what do? They don't make it. They go bankrupt. Companies that were poorly managed or mediocre go bankrupt. And what does that do? That takes more of the market share and it shifts it towards the best companies that are out there. So contrary to popular opinion, recessions are actually a very important part of the economic cycle, not just to see stock prices move in the right directions, but also to actually literally allow businesses that are not good capital allocators go bankrupt so that we can make sure only capital is being deployed towards the best run businesses in the economy. And that closely ties to the second point, which is for the last 5 or 6 years, investors have become very lazy in allocating money because with interest rates being ultra low, it really, as long as the investment could be somewhat profitable, you could make money. If you could make an investment where they were making 6, 7, 8%, you could borrow at 2 to 3% for the loan. It made sense to do it. But today, with interest rates at 8, 9% on a corporate loan, companies cannot make investments that aren't going to make a good 18 to 25%, a much higher threshold for return on capital. And because of that, we are going to see corporations and investors become much more disciplined in how they allocate their resources. And that's only going to help our economy do better because it will make sure that the resources that are rationed go to the right places with the highest return potentials and that can really make the right steps in the right direction. And with that, we'll open it up for questions.
I appreciate that, Josh. Thank you for wrapping us up there. As we shift over to questions, we've got a couple of items to discuss. A couple of questions have been submitted. The first one is something that I think it was provided to us kind of in the middle of the conversation. So it was before we actually gave our perspective on whether or not we were going into recession, but has to do with a couple of the things that we were talking about. So while the numbers say that the quote sky is not falling, can those numbers actually be sustained? One of the things that is asked is the largest, wealthiest cohort in our history is retiring, leading to a reduction in spending and a change in those investing habits. Seems likely that that's going to lead to higher capital costs, lower economic activity. How do we reconcile this, or how do we navigate that going forward as an economy?
Yeah, great question. So as we mentioned, we do think a recession is likely to come, and once again, it's because those numbers are as good as they are right now. It's because those numbers are as good as they are that inflation continues to remain sticky and pernicious, and the central bank is going to continue to be forced to raise interest rates and do other things to ultimately break the economy. Not because those numbers can't be sustained. The numbers could be sustained. But the Federal Reserve does not want those numbers to be sustained. They want to stop them. And I want everybody to hear me when I say this. The central bank's desire right now is to hurt the economy. and I'm not misstating that. They want to hurt the economy because they need to hurt the economy enough that inflation can finally get back to their target of 2%. So absolutely, those numbers cannot be maintained, not because the economy won't allow them to be maintained, but because the central bank will not allow them to be maintained. They will continue to raise interest rates or do other quantitative tightening measures in order to stop them. In relation to the second component of the question, the wealthiest generation retiring does provide some unique backdrop to this discussion. They do generally spend a little bit less, but as a general rule, it really is going to come down to how well financed those who are retiring are, and and exactly how big of a disparity is it going to be from a spending standpoint. As y'all noticed, when we looked at the top 4 quintiles of income versus the bottom, there was a huge difference in the amount of assets that they had. And so if the group that we have retiring is in those top 4 quintiles, we may not see as big of a drop in spending as you would expect. If a lot of those people happen to be in the bottom quintile, then yes, I would say that that is accurate. I think the bigger area that'll impact, though, is as the wealthiest generation retires, we will see continual tightening in the labor force market. And then the other point that was made in the question, which I also think is accurate, is we will see an increased cost of capital. Because typically when someone retires, what's their goal? Their goal is to take less risk. And when their goal is to take less risk, that's less money that can go into risk capital. It's less money that can be invested in more growth opportunities. That kind of money tends to go into bonds or other more safe investments. And so I do think that that will be something that will cause pressure to the downside and be a headwind that we'll have to face.
Right. Thank you. We've got one more question, which relates to the fact that we are going into recession. And I think the best way to state it is that not all recessions are created equal. And the question is, with all of the data looking so positive, at least currently, that sounds like that might likely be changing in the future. What do we expect from a severity of this recession going forward? Is this something where we should expect, say, a 2008 type of scenario, where it was one of the largest recessions that we saw since the Great Depression? Or is it something that's likely to be less severe? Josh, can you answer that one for us?
Sure. It's important in finance to recognize this concept called recency bias. It's the idea that we take our most recent experiences and we project them forward as the most likely outcome in the future. And as a result of that, when we think of recession, we think of 2020, 2008, the dot-com bubble, which happened to be 3 of the absolute worst recessions that this country has ever seen. And so not every recession has been that bad. We've had 13 major recessions since the Great Depression, and most of them have not been nearly as bad as the most recent 3 that we have had. We tend to think that it is likely that this recession will be more mild. However, 2 things. First, the longer that the central bank has to raise interest rates, the worse it will be. So the longer they have to raise interest rates, the longer they have to make access to capital a harder thing to get, it is more likely that they will break something, and they will break it much harder. We've already begun to see some things break. We saw several banks ultimately have bank runs, largely driven by interest rates moving up, causing their assets to drop in value and having people be concerned that their assets were no longer safe at the banks. And so that's one example of something breaking. And at this point, the Fed looks like they've been able to assuage the fears of individuals. And it looks like that may not be something that ultimately is the cause. We'll see. But raising interest rates perpetually and continuing to do it will cause things to break. And eventually it'll cause things to break enough that inflation will reduce and the Federal Reserve will not have to increase. So if it happens in short to medium order, and the central bank doesn't have to raise rates a lot from here, I would expect that it's probably going to be more of a mild recession. And to be very clear, we don't have a crystal ball. No one does. And so while we expect that there will be a recession, because historically that's always been the case in a situation like this, there is a first time for everything. And so we as financial advisors are not being so foolish as to completely preclude the idea that we might not have one. We just, as a general rule, though, are not planning based on that because we don't think it's prudent to do so.
Excellent. Well, I appreciate that, Josh and Laura. Thank you guys for joining us. That's all the questions that we have. If there are any other questions that you guys have and would like to check in with us, please do shoot us an email, give us a call. We're always here to help you guys navigate the complexities of this environment. And as you guys know, the title of this podcast or of this webcast is Beyond the Noise. We're really trying to help you really sift through all of the complex noise that we hear around us to get down to the real kind of root of what's happening so that we can make well-informed decisions about how we invest our capital and how we plan for the future. So we're always here for you. Thank you for taking the time this afternoon to join us. You guys have a great rest of the week.